Good afternoon. Thank you for joining us today for our webinar, Buy-Sell Agreements That Work. As background, let me tell you a little bit about myself. My name is Eric Blocher, and 22 years ago I was fortunate enough to begin working for McKonly Asbury, and Lord willing, I'll be here another 22 years. I am a certified public accountant and a certified valuation analyst. I am an active member of the Pennsylvania Institute of Certified Public Accountants statewide Business Valuation Committee. I am an officer of the East Pennsylvania chapter of the National Association of Certified Valuators and Analysts, as well as an officer on the Estate Planning Council of Central Pennsylvania. I have a real passion for business valuation and the issues surrounding it, and I lead our firm's valuation practice. Over the past 22 years of my professional career, I've had the opportunity to review many different buy-sell agreements. What I have learned over that time is that most of those agreements would not work as intended. In today's webinar, I'll share with you what I've learned so that yours or your client's buy-sell agreement will work. Here's what we're going to accomplish this afternoon. First, we're going to establish the viewpoint of today's webinar. Second, tell you why your buy-sell agreement won't work. Next, we'll provide an overview of buy-sell agreements. We will then make our recommendations. And lastly, we will review some sample agreements and discuss their high points and low points. Questions are welcome and will be addressed at the end of the webinar. My focus today will be on buy-sell agreements from a valuation perspective. We will look at critical elements that should be included in all agreements. It is absolutely essential that you retain competent legal counsel whenever you're drafting or revising your buy-sell agreement. Now we're going to look at why your buy-sell agreement won't work. This is a bold statement, but one that's based on review of many agreements over the years. Chances are that your agreement is flawed and won't work as you intend. In this section, we'll discuss why you, as a business owner, need a workable buy-sell agreement. We will review typical problems with buy-sell agreements that cause them not to work. And finally, after pointing out the many problems that buy-sell agreements can have, I'll highlight the light at the end of the tunnel. It is a good idea and a sound business practice to have a buy-sell agreement in place. In fact, if you're in a business with more than one owner, you need to have one in place. Here are 7 reasons why you need to have a buy-sell agreement. The ownership interest in your business is likely your most significant asset. It's not uncommon for it to account for 70 or 80% of your total net worth. This asset needs to be protected. A buy-sell agreement will create a market for a closely held interest. Having a market to convert your asset to cash is extremely important. Just ask anyone who's sitting on property in Florida how important the market is. A buy-sell agreement provides a framework for dealing with owner disputes and when other bad things happen. These other bad things are triggering events, and we'll go into them in more detail later. A buy-sell agreement forces shareholders to deal with funding and liquidity issues. These are critical issues, and we'll talk about them more later. They allow shareholders to control who they are in business with in the future. They can facilitate estate planning objectives. Last, and certainly not least, it can provide peace of mind to owners knowing that their family will be treated fairly. Let's talk about problems with buy-sell agreements. The first problem that I see is that agreements quickly become dated. The agreement usually is executed early in the life cycle of a business, but as time goes by, the business changes, but the buy-sell agreement doesn't. The next problem I frequently see is that valuation language in the agreement is not clear. This is understandable considering that owners and attorneys aren't trained in valuation, but language that is not clear and understandable leaves room for interpretation. And interpretation is never a good thing when there are two parties that may have divergent interests. Critical elements of the agreement may have been overlooked and left out. These need to be in place if the agreement is to work properly. We'll talk more about this in a little bit. The valuation provision may be inappropriate or dead wrong. For example, assume we have a buy-sell agreement with a provision in it stating that the business is worth $1 million, but the true value of the business is $5 million. Now one of the two owners dies. The estate will receive their 1/2 interest in the $1 million. Is that fair? The estate may not think so, but I'm sure the business does. Now let's look at it from a different angle. Assume the same facts, except for that the true value of the business is only $200,000. Now, one owner dies and the estate has a claim for $500,000. Now, from the business's standpoint, they don't think it's fair, but the estate sure is happy. This brings me to an important point that business owners need to consider. They could be on either side of a transaction. They could be the owner that has to buy, or they could be the owner that is trying to sell. In light of that, it's critically important that the valuation process is reasonable and fair to both parties. The next problem with buy-sell agreements is that change happens. Industries change, businesses change, ownership interests change, but buy-sell agreements are rarely changed to reflect those. The last problem with buy-sell agreements is that ownership interests diverge over time. If there was an issue with your agreement before a triggering event, once that event happens, the likelihood of that issue getting fixed is slim. I want to talk more about when critical elements of the agreement are missing. Let's first talk about triggering events. Are all appropriate triggering events included? My experience shows that the answer to that question is no. The most common triggering event is death, and that's usually found in every buy-sell agreement. But what happens if an owner quits? What happens if they're fired? What happens if they retire? If they become divorced? What happens if they become disabled or file for bankruptcy? These events are much more likely to happen than the death of an owner, but yet death is the one thing that's covered in almost all buy-sell agreements. One thing to think about is the definition of these terms. For example, what does it mean to become disabled? Without a clear definition of what this means, you could find yourself in litigation very quickly. Let's look at ownership rights. Who owns the stock after a trigger event? What rights are retained? Do they retain voting rights, rights to distributions, rights to receive financial information? If this is not spelled out in your agreement, you may find yourself in a position where you need to make distributions to a former employee. I have read agreements with language in it that says the shareholder only retains a right to receive the purchase price and has no other rights of ownership. The next critical element that causes problems with a lot of buy-sell agreements is funding mechanisms. Are they addressed in the agreement? Life insurance is the most common funding mechanism, but it may provide adequate funding only in the case of death. Unless there is a cash value associated with the policy, life insurance is going to help you if a shareholder leaves because they're fired, quit, divorces, or retires. If the company owns the policy, does your agreement specify how the proceeds are to be handled for valuation purposes? Are they a funding vehicle only, or are they a corporate asset? There could be a dramatic difference in the valuation of a company depending upon the answer to that question. It is very important to address this in your agreement. In cases where insurance will not work and the company or owners don't have buckets of cash sitting around to fund a purchase, does the agreement spell out in detail the terms for payment of the purchase price, including cash paid out, notes issued to the seller, interest rates of those notes, terms of the notes? Failure to address the details of funding can be like having no agreement at all, and should be addressed when the agreement is drawn up. This can become difficult when the owners don't have a solid foundation for estimating the true value of their company, resulting in inappropriate insurance policies and payment terms that do not meet their needs. What is that light at the end of the tunnel? We've talked enough doom and gloom about why buy-sell agreements don't work, but there is good news. If you're watching this webinar, you're alive and well. That in and of itself is good. It is also likely that none of the triggering events that may be in your agreement or should be in your agreement have happened yet. It is not too late to make improvements to your agreement. You can update an agreement that has become old. You can clear up foggy valuation language. You can address critical elements that may have been left out of your agreement. Trigger events that were not included in your agreement but should have been can be included. Funding deficiencies can be addressed. Ownership interests that have diverged over time can be realigned. You can fix your agreement so that it works. The light at the end of that tunnel means it's not too late. This next section will provide an overview of buy-sell agreements. We'll talk about key aspects of buy-sell agreements, which should be in every agreement. We will review broad categories of buy-sell agreements, and then discuss in more detail 4 specific types of agreements, with the advantages and disadvantages of each. You may see an agreement that looks like yours. I also believe you will find areas where your agreement can be improved. Buy-sell agreements that have a reasonable prospect for working properly share several key aspects. They require agreement between the shareholders at a point in time. This agreement could be very important for estate planning purposes, representing a negotiated arm's-length transaction. The agreement addresses transactions that may occur in the future. There is no guarantee that a transaction will happen, but as Ben Franklin once said, an ounce of prevention is worth a pound of cure. It defines the conditions that will cause the agreement to be triggered. The agreement should contain all applicable trigger events. One of the biggest failures of buy-sell agreements is when an event happens that should have been a triggering event but was not included in the agreement. The agreement should determine the price at which the identified transactions will occur. The price should be reasonable to all parties, and there should be sufficient detail in the agreement to determine the price. The agreement should establish funding requirements for the transaction. As I discussed earlier, an agreement that doesn't contemplate the funding for the transaction on terms that are acceptable to both the buyer and the seller is like having no agreement at all. The agreement satisfies legal requirements. They need to be drafted in such a manner so that they're legally binding on all parties and comply with all applicable laws and regulations. There are three broad categories of buy-sell agreements. The first are cross-purchase agreements. These agreements call for shareholders to purchase shares subject to the agreement. They are often funded by life insurance policies owned by shareholders on the lives of other shareholders. These agreements can quickly become unworkable as the number of shareholders increase. Since the only funding considered is life insurance, these agreements normally require owners to finance stock purchases that are not related to death. And individual owners may or may not have that capability. Due to this type of agreement is typically not effective for non-death trigger events. The next broad category of buy-sell agreements are entity purchase agreements. These call for the entity to purchase the shares subject to the agreement. The entity is responsible for the funding of the transaction, which may be provided through life insurance, financing from a third party, cash on hand, or any combination of the three. The third category are hybrid agreements. These typically give the entity the right of a first refusal to purchase shares on the occurrence of a trigger event. If the entity declines to repurchase the shares, they are usually offered to other shareholders. Most smaller companies with few owners use cross-purchase agreements. Larger corporations with many owners typically use entity purchase agreements. Buy-sell agreements are further classified into four types based on the nature of the valuation provision. They are fixed price agreements, formula agreements, shotgun agreements, and process agreements. Let's take a look at fixed price agreements. They are exactly what you would expect. What you see is what you get. The price is fixed when the agreement is signed. The advantages of a fixed price agreement include that it's easy to understand. Anyone can look at the back of the agreement and see the value that's assigned to the business and understand what that means. They're easy to negotiate. There is generally a common belief among shareholders as to the value of the business at the time it's negotiated. This may be due to a recent transaction or owners' informed guess as to what the business is worth. Fixed price agreements are also inexpensive. There's minimal legal fees associated with setting them up, and there's also no valuation costs with determining the value of the business. In my opinion, there are significant disadvantages which cannot be overlooked. Fixed price agreements quickly become outdated. As time passes, the business changes, economic conditions change. Therefore, I believe the value of the business will change, but a fixed price doesn't reflect that. How the price was originally determined may not be realistic or fair. The fixed price might not even be in the same ballpark as one that could be negotiated through an arm's length transaction. If a shareholder were to die and the buy-sell agreement was used to determine the estate value, odds are that the value would not pass IRS scrutiny. Virtually every fixed price agreement calls for the valuation to be updated periodically, but it's my experience that they seldom are updated timely, if ever. Therefore, if you have a fixed price agreement, we recommend that you put it in the corporate bylaws that it must be updated at least every 2 years or when there's a material change in the business. Let's talk about formula agreements. Formula is stipulated in the agreement that will be followed to determine price. The formula itself can be based on many different factors. It can be based on book value, where the price is tied directly or indirectly to the book value of selected assets, liabilities, or equity. An example of this would be 2 times book value of the owner's equity would be the price agreed to. In my opinion, book value is a very poor determinant of value, and there's case law supporting this belief. The formula could be based on some form of earnings. It could be based on a multiple of EBITDA, which is earnings before interest, taxes, depreciation. It could be based on cash flows. It could be based on net income. It could be based on operational income. An example would be price of the company would be equal to 5 times earnings before interest, taxes, depreciation, and amortization. The formula could also be based on some predetermined financial metric. For example, price of the company could be based on 50% of trailing 12-month sales plus accounts receivable, or a percentage of sales revenue. The price determined from a formula agreement is only as good as the formula itself. The advantages of a formula agreement are: 1, it's easy to understand. Once the formula is determined, the price can be calculated. Doesn't mean it's right, but it's easy to understand. They are also easy to negotiate. As was the case with a fixed price agreement, there's a general perception among shareholders that the formula will determine a value that reasonably approximates the true value of the company. Formula agreements are also inexpensive. They generally don't require a lot of legal fees, and they do not require an ongoing valuation to value the company. There are disadvantages which should not be overlooked. As with a fixed price agreement, the formula can become stale. As the business, the industry it operates in, or economic conditions change, a formula that may once have given a reasonable approximation of value may not do so. Another disadvantage is that the formula may not be as clear as it appears on the surface. Without a clear, concise definition of every aspect of the formula, it may not work as intended. I reviewed an agreement several years ago that was a great example of this. The agreement contained a formula that said the price of the business was determined by 4 times income. What it didn't have was a clear, concise definition of income. Was it net income? Was it operational income? What were you to do if they had a loss for the year? Fortunately, we brought it to the owner's attention prior to a trigger event occurring, and they were able to fix the agreement. One of the biggest disadvantages of a formula agreement is that it does not allow for flexibility when flexibility is needed. On the next slide, we'll walk through an example showing the implications of not having flexibility in your formula. Let's begin with what appears to be a very simple formula. Price equals 5 times EBITDA, which is earnings before interest, taxes, depreciation, and amortization. It seems straightforward, right? But what period does the EBITDA cover? Does it cover year to date? Does it cover the trailing 12 months? What happens if the triggering event occurred 1 month into the year? Are we to base the value of the business on 1 month EBITDA? You can see from this example so far that it should have been clearer in its definition as far as 5 times what EBITDA. If they, for example, they had said 5 times the trailing 12 months EBITDA, we would have been able to determine the price according to the formula. But now let's dig a little deeper. What happens if there was a significant non-recurring event during the year? For example, let's just say they had $1 million recovery from a legal proceeding. If the company had $500,000 of EBITDA prior to that non-recurring event, the normal value of the company determined under the formula would be 5 times $500,000, $2.5 million. If we include the $1 million recovery, then we look at EBITDA of $1.5 million. 5 times that is $7.5 million, a difference of $5 million, a significant difference. If after reviewing the agreement we determined that the $1 million needed to be included in EBITDA and calculated the value of the business at $7,500,000, is that fair? From the viewpoint of someone who may be trying to sell their share, it sure is. But from the company's viewpoint, it may be crippled by having to pay out that type of price. The other side of the coin can be considered if we look at a $500,000 write-down of inventory. Same facts and circumstances as before with the $500,000 normal EBITDA, but now we have a write-down of $500,000. If we consider this, they would have no income during the year. Does that mean the company has no value? If we don't consider it, the value goes up to $2.5 million. If you were a selling shareholder, how would you feel to know that your interest could potentially be determined to have no value? As you can see from this example, vague language, lacking clear descriptions, can have a drastic impact. I go back to the question, should the adjustments be included? A formula agreement may not allow adjustments that would otherwise be deemed beneficial by management. Even if the formula is reasonable at the execution of the agreement, and this is a big assumption, it needs to be explicit in its description or it could quickly turn into a train wreck. Another type of an agreement is called a shotgun agreement. This is an agreement where after a triggering event occurs, one party makes a determination of price and the other party is able to buy or sell at that price. The shotgun feature typically requires that the transaction happen, but the sticking point is that you don't know which end of the shotgun you'll be looking at, the buying end or the selling end. The concept is based upon the premise that the initial offer virtually has to be fair because no one knows that they will be buying or selling. This agreement reminds me of an incident when I was younger. My brother and I were getting ready to fight over the last piece of cake available. My mom heard us fighting and came into the room. She said, "Okay, Eric, you can cut the cake in half, but your brother gets to pick which slice he wants to eat." That ensured I was going to make them as equal as possible. The advantages of a shotgun agreement are that it's easy to understand. Virtually anyone can understand the process. It's also easy to negotiate. There is a perception of reasonableness that's a compelling argument going forward. It is also inexpensive. There's less legal costs and no appraisal requirement. The last advantage includes pressure for a reasonable price. It does have significant disadvantages though. It assumes all parties have sufficient financial capacity to complete a transaction and that all parties have equal knowledge of the business to make informed decisions. These assumptions may not be true and usually are not true. For example, if there are two shareholders and one's a non-operational shareholder, the non-operational shareholder may be at a distinct disadvantage. They may not know enough about the operations to make a determination of what a fair price is. Also, as a non-operational shareholder, could they really buy the company and operate it effectively? Minority shareholders could be at a disadvantage as well. Let's assume there are two shareholders of a company. One's an 80% shareholder and one's a 20% shareholder. The 20% shareholder may not have the financial capacity to make an offer that's reasonable for the 80% shares. They may have to come in at a low price. Is that equal footing? It doesn't sound like it to me. The final disadvantage is that no one knows what the final outcome will be. As a result, there's a great deal of uncertainty. People that are buyers don't want to become sellers, and people that are sellers don't want to become buyers. Let's look at valuation process agreements. These are agreements that establish a valuation process to be followed after a trigger event occurs. There are two types of valuation process agreements, which I'll review in more detail later. The first one is a multiple appraiser agreement. The second one is a single appraiser agreement. Regardless of which type of process agreement you have, there are critical elements of the process which must be defined. If these elements are not defined, and defined clearly, chances are the agreement will not work. The following elements must be defined in each process agreement for them to work properly. I would add the elements we're about to discuss should be included in every buy-sell agreement. The first element is standard of value. This is the cornerstone of every valuation. It needs to be identified to determine the type of value that you will be arriving at. We will look at different standards of value shortly. The next element is level of value. The level of value determines whether the price will be based on a pro rata share of the whole business or in a specific identified interest. The level of value is so important that two separate appraisers can agree on the total value of a business, apply different levels of value, and their conclusions could be drastically different. We will look at the different levels of value in more detail later in this webinar. The next important element of the process is the effective date. The effective date is based on the premise that every valuation is performed as of a specific date and time. That date needs to be known to perform a valuation. The next element is determining the qualifications of appraisers and appraisal standards to be followed.
Factors to consider when selecting an appraiser include their education, their valuation training and experience performing valuations, their industry-specific experience. If your company operates in a niche industry, you want to make sure that you have a valuator or appraiser that has experience specific to that industry. You also want to consider their credentialing. Credentialing is very important.
Holding a business valuation credential is an indication of a commitment to the valuation profession. There are several appraisal organizations and professional credentials. Here are a few. The American Society of Appraisers issues the ASA, which is the Accredited Senior Appraiser designation. The American Institute of Certified Public Accountants issues the ABV, which is accredited in business valuation.
The National Association of Certified Valuators and Analysts issues the CVA, which is the Certified Valuation Analyst.
The CFA Institute, which issues the Chartered Financial Analyst designation. And the Institute of Business Appraisers issues the CBA, Certified in Business Appraisal designation. Any of these designations will indicate a commitment to the profession. It is also important that you define the appraisal standards to be followed. Those standards require credential appraisers to operate under standards of professional practice and code of ethics. The bottom line is that those appraisal standards increase the quality of an appraisal performed for your buy-sell agreement. The last critical element to a valuation process agreement is a funding mechanism. Previously, we stressed that if you don't have funding mechanisms identified in your buy-sell agreement, it is as if you have no agreement at all. The absence of any one of these elements can render the agreement unworkable. Let's look at the first two elements in a little more detail. The first element is standard of value. It answers the question, value to whom?
Because an equity ownership interest in a business can have at least a dozen different values at any given time.
It gives the direction for the entire valuation. There are different standards of value, such as fair market value, fair value, and investment value, each of which can result in dramatically different values. Fair market value is the value that's used in all tax engagements. It was defined in Internal Revenue Service Revenue Ruling 5960 as the price at which property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of all relevant facts.
In my opinion, fair market value is the standard of value that should be used in most, if not all, buy-sell agreements. Investment value is the value to a specific investor. It contemplates factors not considered under fair market value, such as synergies, operational efficiencies, excess capacity, and other factors. Fair value is the standard of value used in dissenting shareholder cases and in some divorce and family law work. It's a statutory concept. Let's look at level of value. It's important to note that there is not just one level of value for an entity, there are many. The graphic on the next slide, which is used with permission, illustrates the differences. The graphic in this slide depicts the four generally accepted levels of value. Each level of value for an entity will have a different numerical value associated with it. It's critical that the level of value be defined explicitly in the buy-sell agreements. On the left-hand side of the chart, you'll see two levels broken out, enterprise levels and shareholder levels. The enterprise levels consider both the debt and the equity of a business in the value it determines. Within the enterprise levels, we have the strategic or synergistic control level, which can be considered or is often thought of as an investment value because it has synergies and other specific factors which you would consider under the investment standard of value we discussed previously. It also has the financial control value. The difference between both of these control levels of value is the application of a synergistic control premium or accounting for the synergies in some manner. Below the enterprise levels of value are two shareholder levels of value, the minority marketable level of value and the minority non-marketable level of value. The minority marketable level of value is the value associated typically with stocks that are held in the New York Stock Exchange that are at a minority level but certainly have a market and are easily traded with minimal transaction costs. The difference between the financial control level of value and the minority marketable level of value is represented by a discount for lack of control, typically applied to the financial control value to arrive at the minority marketable value. The minority non-marketable level of value is the lowest level of value on this graphic, and it reflects the value of a minority interest lacking both control over the entity and not having an active market. At this point, I'd like to highlight that as we go down the levels of value from strategic or synergistic control to financial, then to minority marketable, and then minority non-marketable, the values all decrease. The synergistic control is the highest value, and then the minority non-marketable would be the lowest value. The value of a company determined under the strategic or synergistic control level of value and the minority non-marketable level of value can be drastic. So it's very important that the buy-sell agreement identify specifically what level of value is to be used. Let's look at one of the valuation process agreements. The first agreement is a multiple appraiser agreement. These are agreements where, when a trigger event happens, the company and selling shareholder each select an appraiser to value the interest to be sold. The two separate appraisals are compared, and if they are within a certain range, say 10% of each other, the value is determined by the average of the two appraisals. On the surface, this provision may sound reasonable, but having two appraisals prepared by two different appraisers reach conclusions of values that come within a specified range can be more unlikely than you would think, especially when you consider the elements that need to be defined in the buy-sell agreement for them to work properly. So if the value is not within the selected range, a third appraiser is selected by the first two appraisers typically to perform a third appraisal. The third appraisal would then govern, or an average of all three would be used to determine the value of the company. Let's review some of the perceived advantages of multiple appraiser agreements. The first is that it provides a defined process for determining the price. The second advantage would be that all parties involved would know what the process entails. A third advantage would be that a multiple appraiser agreement is common and understood by business owners and attorneys alike. A final advantage would be that both parties believe that their interests are protected by selecting their own appraisers. Now let's look at some of the disadvantages. In this type of agreement, no one knows what the value of the company is now. Rarely does this type of agreement have a provision that will require an initial valuation. The owners typically don't want to go through the time nor expend the funds necessary to go through the process to see what the value of the company would be at the time the agreement is drawn up. Another disadvantage is that this type of process agreement is very time consuming. Time is spent by each party finding qualified appraisers and then selecting their appraiser of choice. And then the appraisal process begins, which can be lengthy and time consuming. Each appraiser will submit a comprehensive document request list that will include all financial information, operational information, and other information they deem necessary to perform their valuation. It can take management a great deal of time to gather all this information, time not spent with the day-to-day operations of the company. Once the appraiser receives this information from management, they review it all in detail, develop questions that they want to ask management, enter all the information into their valuation spreadsheets and software that they use. They will typically seek out a meeting with management. They will come on site, they'll take a tour of the business, they may interview key individuals, they may ask questions about operations and plans for the future of the business and seek out any other information necessary for them to complete their appraisal. They will take the information gathered at this meeting, analyze it, and complete a draft of the appraisal, which then will be reviewed with management. This process will need to be completed by both appraisers just to see if their value conclusions are within the defined range I mentioned earlier. It is not unrealistic for the valuation process beginning to end to take several months. In the best case scenario where the two conclusions of value are within the reasonable range, there is still an enormous demand for management's time. If the two conclusions of value are not within the reasonable range, the whole process starts again. The two appraisers need to select a third appraiser. That takes time. The third appraiser will need to prepare a list of items they need to see. It may contain new items that haven't previously been supplied. They will need to analyze the data, contact management, set up a site visit, conduct interviews, analyze any new information arrived at during that meeting, and prepare their appraisal report. Overall, as you can see, this can be very time consuming. Another disadvantage of a multiple appraiser agreement is that it can be very expensive. If the conclusions of value arrived at in the first two appraisals are not within the reasonable range established in the buy-sell agreement, you may incur the cost of 3 full appraisals. The last disadvantage with this type of agreement is that issues with the process or agreement itself are not discovered until it's too late. Elements critical to the agreement may be missing, which would cause one or all of the appraisals to arrive at conclusions of value which are unrealistic. By this point, I'm sure I've scared everyone to think that there are no buy-sell agreements that will ever work. Well, that's not the case. This brings us to our recommendation for a buy-sell agreement that will work. The last type of buy-sell agreement is a single appraiser agreement, and there are three types. The first type is to select an appraiser and value at a trigger event. It is exactly what it sounds like. You do not select an appraiser and you do not value the company until a trigger event happens. The second type is select appraiser now and value at trigger event. This also is exactly what it sounds like. You identify in the agreement who the appraiser should be and you value it when a trigger event occurs. The third type is the select appraiser now and value now option. In this type of agreement, the appraiser is identified in the buy-sell agreement and an appraisal is performed immediately after the agreement is effective. We recommend and will focus on the select appraiser now and value now option. This process, as I said, selects a single appraiser which is named in the agreement and a baseline appraisal is performed immediately after the agreement becomes effective. Updates to the appraisal can be performed annually or as desired by the owners. We recommend at least every 2 years that the appraisal is updated. Now let's review what are the advantages and disadvantages of the select appraiser now and value now agreement. The first advantage is that the value of the company will be known to all parties. As I mentioned before, often a business owner's single largest asset is the ownership interest in their business. Having an independent appraiser determine the value of their ownership interest in the business can help them and the business plan for the future. Funding structures can be planned to match the value of the company. We previously reviewed the importance of having a funding mechanism in the buy-sell agreement, but just as important is knowing how much to fund. Having a funding mechanism in place is great and necessary, but if it only covers 1/4 of the liability to the company to buy out a partner, it's not going to amount to much good in the long run. The opposite can also be true, and I've seen this personally happen. A company was funding 3 times the amount it would ever have to pay to buy out any of the partners and was incurring an unnecessary drain on cash flow which could have been used for operations. Another advantage is that all parties will know what the process entails and what will happen at a trigger event. My dad once told me that you can't put a price on peace of mind, and I believe that comes into play here with the business owners as well. One of the biggest advantages, I believe, of the select appraiser now and value now agreement is that issues with the process or the agreement are identified before a trigger event occurs and can be fixed. For example, if one of the critical elements we discussed previously were missing or unclear in the agreement, it would be identified during the appraisal process. The necessary changes to the agreement could be made before a triggering event occurs. The agreement would work as intended. The last advantage is that a select appraiser now and value now agreement is less expensive and less time consuming than multiple appraiser agreements. The company will bear the cost and the demands on its time from a single appraisal, not from 3 appraisals as can happen in a multiple appraiser agreement. The main disadvantage of the select appraiser now and value now agreement is that it is more expensive than a fixed price or formula agreement. But I hope you can see that the advantages of the select appraiser now and value now agreement far outweigh the disadvantage. I want to briefly discuss something that's found in many agreements: rights of first refusal. Rights of first refusal are not a true buy-sell agreement. What they are is they're designed to restrict ownership by limiting its marketability. They generally provide that the company retains a right of first refusal to match any bona fide offer to a shareholder under the same price and terms of that bona fide offer. Some agreements have provisions for rights of second refusal to the other shareholders. Let's explore how this might work. If an owner receives a bona fide offer from an outside third party to buy their ownership interest, the owner, who is subject to the agreement, is required to offer to the company his ownership interest under the same price and terms of the bona fide offer. The company typically has a time period where they can either accept or reject the offer. Then, if there's rights of second refusal, the owner must offer the same terms to the other shareholders, who then have a right to accept or reject and a time frame to do so. Only after the company rejects the offer and other shareholders reject the offer, can the interest be sold to an outside third party? Let's look at the advantages and disadvantages of rights of first refusal and rights of second refusal. The advantages are that these rights act to discourage third parties from making offers. If a third party knows that the company and other shareholders have a right to accept the same terms and price of an offer, they could be discouraged from making an offer in the first place. The second advantage is that it gives the company control over new owners. It gives the company, or other shareholders, the right to block a transfer of ownership to anyone they deem as undesirable. Another advantage is that most rights of first refusal require any successful third party to be subject to the same agreement. A disadvantage is that a right of first refusal does not address all the key aspects of a buy-sell agreement and should not be considered a substitute. Another disadvantage is that it provides protection only from outside offers. In summary, although rights of first refusal are not a substitute for a buy-sell agreement, they can often be used to complement and provide additional benefits in the agreement. Next, I want to review some sample agreements that I've come across to help illustrate some of the issues that can arise when the agreements don't contain all the critical elements necessary. The first sample agreement contained the following wording: "The value of the shares shall be determined by dividing the appraised value of the business by the total number of outstanding shares. The business shall be valued as an ongoing enterprise by a qualified appraiser. If the parties hereto cannot agree on the business appraiser who should be retained, then each party shall retain its own appraiser. Those two appraisers shall then select a third appraiser, and the value of the business shall be the average of all three values as determined by the appraisers." Knowing what you do after listening to this webinar, what are some of the discussion points? First, let's look at the elements I said must be defined in the agreements for them to work properly. The first element was a standard of value. Does this agreement define the standard of value? The standard of value answers the question, value to whom? And this wording doesn't have any indication of that. It doesn't mention fair market value, fair value, investment value. As I said before, each of those different standards can give a dramatically different value to the entity, and this wording does not give any indication of which standard should be followed. Does it define which level of value should be used? The agreement does state that the value of the shares shall be determined by dividing the appraised value of the business by the total number of outstanding shares, but it doesn't address whether that level needs to be on a synergistic level, a financial control level, a minority marketable level, or a minority non-marketable level. It's left up to the judgment of the appraiser, and different appraisers can arrive at different conclusions. Does the agreement address the effective date for the appraisal? No, it does not. Does it discuss the qualifications of appraisers and the appraisal standards to be followed? The agreement just references a qualified appraiser and does not mention the appraisal standards that should be followed. It's left up to each individual party to determine what qualified means. What one party deems a qualified appraiser, the other party may not. This is an area for potential conflict. Does the agreement discuss funding mechanisms? No, it does not. The agreement assumes that both parties have the capacity to buy out the other. This is rarely the case. This agreement also did not define triggering events that would cause the agreement to become effective. Additionally, the agreement did not stipulate the terms for any type of payment of the price. This agreement is a good example of a multiple appraiser agreement. I think the parties, when they entered into it, thought it would be fair if they each could pick their own appraiser and then have a third determine it, but I don't believe they really had a concept of the time involved and the potential cost if events were to play out as defined by the agreement. The only conclusion I can come to is that this agreement will not work as the parties intended it to when it was drawn up. Let's look at another example. The operating agreement of this business referenced what would happen on the death or disability or withdrawal of an owner's interest. The agreement states, "The purchase price for the interest shall be based on the agreed value of the company as set forth on Exhibit X, attached hereto, and made part hereof, as the same may be amended from time to time pursuant to Section XX of the agreement. The latest agreed value, which is not more than a year old at the time the mandatory price is triggered, shall be conclusive for the purposes of determining the purchase price." It also contains a provision for voluntary adjustments to be made to the agreed value by the members. Exhibit X of the agreement further states the appraised value will be determined by an independent third party at the time of withdrawal of the owner. The agreement also states the final valuation amount determined by this independent third party will be binding on the withdrawing owner. The independent third party to be used is named in the agreement. What are some discussion points here? Let's look at the critical elements. Standard of value is first. Do they reference a standard of value in the agreement? No, they do not address the standard of value. Do they address and define level of value? Nowhere in the agreement do they address the level of value to be used. Is the effective date addressed? It does mention that the appraised value will be determined by an independent third party at the time of withdrawal of the owner. It gives a little indication, but it doesn't specify what the effective date would be. Does the agreement address the qualifications of the appraisers and the appraisal standards to be followed? No, it does not. It just addresses an independent third party. Does the agreement address funding mechanisms? Although not addressed in the sections of the agreement I've shown here, it did include detailed funding requirements, how it would be funded by life insurance, who was responsible for paying the premiums, and the amount of insurance to be maintained. So it did a better job than most at addressing this element. Did the agreement address all appropriate trigger events? It did address death or disability or withdrawal of an owner's interest, but it didn't identify some potential triggering events such as divorce or bankruptcy. One head-scratching aspect of the agreement is the provision for voluntary adjustments to be made to the agreed value by the members. Why the company would go through the time and expense of hiring an independent third party to determine the value of their company, only to have the value adjusted by voluntary adjustments by its members, is beyond me. On a positive note, the agreement did identify the independent third party that was to be used when a triggering event occurred. Nonetheless, this is still an agreement that would not work. Let's briefly sum up what we've gone over today. Let's summarize the important points from today's webinar. The first point is that buy-sell agreements are critical business and legal documents. If you have more than one owner in your business and don't have a buy-sell agreement in place, you should. The second important point is most buy-sell agreements will not work as intended. We've reviewed many of the reasons why I believe that is the case. Most agreements don't define critical elements which must be in place for them to work properly. The third point is an important one for your peace of mind. It's not too late to fix your buy-sell agreement. If a trigger event has not occurred, you can still change it. Lastly, we recommend the Select Appraiser Now, Value Now type of agreement, and to have an update appraisal at least every 2 years so owners have an indication of the current value of the business. If you would like to learn more about buy-sell agreements, there's an excellent reference material you can buy, a book by Christopher Mercer available at Mercer Capital called Buy-Sell Agreements for Closely Held and Family Business Owners.
Thank you, Eric. And thank you all for joining us for today's webinar on buy-sell agreements that work, brought to you by McKonly Asbury. We will be sticking around for a while to answer some of your questions that have come in, and please continue to submit them or email us directly with any other questions, and Eric will be happy to answer them. As a reminder, you will be receiving CPE credit for attending this 1-hour webinar. CPE certifications will be sent out via email within the next week. You will be receiving a follow-up email to this webinar with a link to a short survey about the webinar that we would appreciate your feedback on. We will be posting a recap of today's presentation on our blog at www.macpas.com/MA-news. Look for that post to be up by the end of the day tomorrow. So Eric, it looks like we did get a few questions in.
Yes, we did. The first question says, if you choose the Appraiser Now and Value Now agreement, wouldn't this also get stale? How often would you recommend getting the appraisal redone? I think I talked about it earlier in the webinar, but then at the end in our recommendations, what we find is, and like to recommend, is have it updated every 2 years. That would typically cover and prevent the agreement from getting stale. Another question that just came in, what do appraisals typically cost for a $2 million service company? Well, isn't that a loaded question? The appraisals, what I always tell my clients is that the cost of an appraisal depends on the facts and circumstances of the specific company. You can have a company that has a lot of revenue where the valuation is not that complex and the cost can be lower, or you could have very low revenue client that has a lot of intricacies with it and the cost can be higher. Typically what I see in our area is appraisals can range anywhere from, depending on the services being offered, for a full scope appraisal from $7,000 up. I've seen and have done appraisals for upwards of $30,000 due to the complexity of the business. One other question that came in was, at what point do the number of shareholders limit the effectiveness of a cross-purchase agreement, and what have you seen in your practice? I've seen a lot of agreements that do have cross-purchase provisions, but typically those are in agreements where there are few owners. If you think about it, with two owners, there are two relationships and then two policies that would need to be purchased. If there are three owners in the business, that represents 6 different relationships and 6 policies that would need to be purchased. If there are 4 owners, that's 12 relationships and 12 policies. I rarely have seen a cross-purchase agreement in place just due to the cost of it beyond 3 owners. So that's usually the cutoff, at least that I've seen in my practice. Okay, one last question to review. What are some of the qualifications or experience to look for when selecting the appraiser? Well, let me first go into and say that the body of the valuation knowledge is very vast. That's one of the things that has drawn me to it and why I'm so passionate about it. It's constantly evolving, and you really need to keep on top of the current thinking and the thought process out there to be good at it. And the first thing I would say is that valuation is not something that anyone should dabble in. It's really a full-time profession, and you need to look for someone that's doing it on a full-time basis. So I would look for that full-time commitment. I would also look for evidence of a certification or designation, and that just, to me, represents a commitment to the profession. I would also look for industry or niche experience for whatever your business is in, whatever specific industry or niche experience or business you're in. Look for that experience with the appraiser. And then I would also look for a commitment to continuing education. That also represents that they're current with what's going on. New case law can come out at any time and can drastically change the thinking of evaluators across the country. So you need to, or should have, someone that's keeping apprised of those situations. One last question came in. Do appraisers normally factor in the value of intellectual property, customer base, value of contracts in place? Depends on what the purpose of the appraisal. Sometimes they do, yes, and an appraisal should factor that in. But typically where that may come into play is the ability to earn cash flow that's greater than the competitors. And I'm always a believer that cash is king, and that cash flow is typically what an investor or any investor in a business is going to look for. That having these factors in place, intellectual property or customer base, will just factor into a greater cash flow when with this company compared to when you look at competitors. Hope that answers the questions.
Yeah, thanks, Eric. I think that's going to wrap it up for today's CPE. Be sure to check out our website again at www.macpas.com/MA-news, and we have free webinars that we will be broadcasting every month. So be sure to check out that website for information on the next upcoming few webinars.
Yes, I just want to thank you once again for tuning into the webinar. My information is up on the screen. Feel free to call me or contact me. As anyone who's worked with me can tell, I love to talk about this stuff, and I'm very open to your discussions and talking about business valuation. So please feel free to give me a call. Thank you.